Hey, welcome to The Explainer. Today, we're diving into personal finance. We're going to show you how to get a handle on your money, sidestep those hidden traps, and actually start building real wealth. Ready? Let's get into it.
All right, let's kick things off with this really powerful idea from financial educator Aman Doddarwal. This quote gets right to the heart of why managing money can feel like such an uphill battle. It suggests that the whole system kind of feeds on our insecurities, pushing us to spend more to feel better.
And that's the big question, right? It's so easy to feel like the odds are stacked against us. But here's the thing. It doesn't have to be that way. You can absolutely win this game. You just have to understand the rules. And that's exactly what we're going to break down.
So first things first, let's talk about the number one reason why your savings might be quietly losing value, even when you think you're doing everything right. It all comes down to a little thing called real inflation.
You hear that number on the news, right? For maybe 6% inflation, and you think, okay, that's not great, but I can handle it. But that official number doesn't really tell the whole story. It tracks a huge basket of goods, but what about the really big expenses? The ones that actually make a dent in your budget?
And this is where it gets really interesting. This chart breaks down your personal inflation rate. Things like education, housing, healthcare. Look at those numbers. They're seeing double-digit increases every single year. So what that means is your money needs to grow by at least 8 to 10% a year just to break even, just to keep up.
And this number right here just drives the point home. Let's do the math. Say your savings account gives you 3.5% interest. Not bad, right? Well, after you pay taxes on that, about 30%, your real return is only about 2.45%. Now, subtract that 8% real inflation we just talked about, and suddenly, your money is actually losing over 5% of its buying power every single year. It just sits there.
So yeah, clearly just saving your money in a bank account isn't going to cut it. To really get ahead, you need to understand two basic principles that are they're like the physics of finance. They just always work.
The first rule is the time value of money. It sounds complicated, but it's a really simple, powerful idea. A dollar you have today is worth more than a dollar you get a year from now. Why? Because the dollar you have today can be put to work. It can be invested and start earning more money through compounding, which is basically just your money making babies and then those babies making their own babies. It's the ultimate snowball effect for your finances.
And that brings us to rule number 2, return on investment, or ROI. This is just how you keep score. It's how you measure how well your money is performing. So if you invest $100 and it grows to 110, that's a 10% return. It's a simple percentage that lets you compare completely different things, like a stock versus a rental property, to see which one is working harder for you. Okay, so now that we know the rules of the game, let's talk about the tools you can actually use to put these rules to work for you.
So the two big ones you're always going to hear about are stocks and bonds. With stocks, you're buying a tiny piece of a company. You're an owner. It's riskier, sure, but it also has a much higher potential to grow. With bonds, you're basically acting like a bank. You're lending money to a company or a government, and they promise to pay you back with interest. It's safer, much more predictable.
And of course, it's not just stocks and bonds. Your toolkit can have other things too. You can invest in physical stuff, like real estate, or gold, which people have trusted for centuries, especially when things feel a little shaky. And then you have index funds, which are amazing. They let you buy a tiny slice of hundreds of different companies all at once, so you're instantly diversified.
I know. Hearing about stocks, bonds, funds, it can all feel a little overwhelming. But the actual strategy to get started and put it all together, it's way, way simpler than you might think.
Okay, so check out this absolutely brilliant practical system from financial creator Adith Dahiya. It's super simple. The second you get paid, you automatically split your paycheck into 3 different bank accounts. One is for your needs, rent, bills, groceries. The second is for your wants, eating out, hobbies, fun stuff. And the third, and this is the most important one, is for your future you.
This future you account is the secret sauce. It's non-negotiable. This is the money that goes straight into your investments before you even get a chance to think about spending it. By automating it, you make sure you're consistently building wealth and letting that incredible power of compounding do its thing.
And all of this brings us to the last and, honestly, the most critical piece of the puzzle. You can have all the best tools, the perfect system, but if you don't have the right mindset, none of it matters.
This quote just says it all, doesn't it? Building real wealth isn't about chasing some hot stock tip or trying to get rich quick. That's a fast track to being broke. True, lasting wealth is built through a disciplined, consistent, and kind of boring process. So the big takeaway is this.
Forget trying to predict the perfect day to buy or sell. Nobody can do that consistently. The real secret is just being consistent. By investing regularly, month after month, year after year, your money grows through all the ups and downs. It's your time in the market that builds wealth, not your timing of the market.
So we'll leave you with this question to think about. It doesn't have to be some huge life-altering decision. Maybe it's just opening that third bank account. Maybe it's spending 20 minutes tonight researching an index fund. Financial freedom doesn't start with a giant leap. It starts with one small, intentional step. What's yours going to be?